Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Markets.com runs down the major markets. He says the markets have hit a rolling top with the downside led by the Russell 2000. While gold's momentum has stalled, silver still has a strong long-term upside. On the energy markets, natural gas has had a good rally. Ross also has a special offer for our listeners. CEO of InsideTrackTrading.com, Eric Hadik, examines the cycles affecting the markets. He looks at the stock markets, gold, the U.S. dollar, Bitcoin, crude, and agricultural commodities. Author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, looks at what's happening with Canadian real estate. The Toronto market is especially grim. He also says consumer insolvencies in BC are at a record high. Hilliard also comments on the federal budget. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HoweStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HoweStreet.com weekly recap on our homepage at HoweStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Markets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Always a pleasure, Jim.
Ross, how would you describe what's happening on the stock markets right now?
Well, it's a rolling top up here, and it's been led on the downside by the Russell 2000. Gosh, this is similar to a year ago as the Russell topped first, and then other indices joined the parade. And just to show the divergence that's going on out here, we know that the big names, the Metas, the Teslas, the Netflix, that really led the move off the April low up until the spring. Most of those names from the Mag 7 have gotten tired and rolled over. And if we look at it, the Hindenburg-Ullman, which measures the number of new 52-week highs and 52-week lows, looking for potential divergences, that has had 6 signals within the last week and a half. That's blowing away the records as far as this is concerned. Typically, you would get 2 or 3 within a 30-day window, but this now shows just how much divergence there is going on out there. So there's huge rotation going on, and clearly, if you were in one of the big high flyers on the upside, and that's not just the Mag 7, I mean, it's the other things that have been happening on AI. The companies that are into building the infrastructures and providing the power for these things, they are all starting to look, well, they're pretty heavy at this point and giving up ground. So a rolling top here. If you take a look at the S&P and the NASDAQ, they've pulled back to their 50-day moving averages. So coming off the April low, this is now the second time that we've had a correction back to the 50-day. We're starting to see some oversold conditions there, but if it gives up anything further on the downside, there's probably a fair amount to be had before correction's over. Now, seasonally, we're into the point where you'd be looking for an important low from which to have your Christmas rally, and that one typically would carry you right into January. So our global M2 model, that's money supply on a global basis, that model is pointing towards the early part of December, from which we could see a low and then a move to the upside. So here we are, the 14th, 15th of November, maybe another week or two of downside, and we'll look for a good oversold condition to play the seasonal rally. And, maybe there's going to be something in it this year.
What's going on with gold?
Gold, we dropped to the appropriate low we've been looking for the 34-day moving average, which was just perfect after the big exponential high we had in April. So gold has retraced 60% of the decline that it had, and looking tired at this point. We were suggesting to subscribers that this week that the first day that we moved the lowest short-term moving average should see a correction back and retest the lows that we saw in the early part of the month. Looks as though that's in place now, so a decent correction in gold is what you would expect. The big flyer on the upside has been silver. We've been thinking that 49 to 50 might be the best on the bounce there. Well, it got back and totally tested the high that we had on the spike to the upside a month and a half ago. Now, when you look at silver, when you have those big spikes to the upside, and we go all the way back to the 1960s, there's 11 good examples like this, and virtually all of them come back for a retest of the high, typically within a 12 to 20-day window. This one is at 20 days, so it's a good spot from which this retest of the $54 level is in place. The important support we still see is down around the low 40s, and on the upside, at some point next year, the 5-year cycle high should come into play. So it's hard to say whether that's going to be just another retest of this $54 level, or if we're going into the upper channel, and we've got upside targets that are up both in the $75 and $120 range if this thing really starts to gain some momentum. So a deep correction would just be a great way to shake out the tree and set us up for a rally in next year.
What's going on with crude?
Crude was, starting to gain some momentum back on the downside, but at the end of the week, it's bounced back over $60. The seasonal still points lower. The best thing you want to do is have a good oversold reading in late November through December, and the $56 low that we had back in October. Ideally, you want to see us take that out and be ready to create a better low down there. Now, within the energy complex, natural gas has had quite a good rally off the lows. We've gone from $250 up to $450 in a span of a couple of months. Seasonally, we are in November is the point at which you start to look for a top in natural gas, and the weekly charts here are giving signals that are very, very common around highs. So, it's time for natural gas to take a breather, probably a big breather on the downside.
What's happening with the U.S. and Canadian dollars?
U.S. dollar working off that double bottom very nicely. Got up to on the futures contract, we got up to 100. That retested the July-August highs, and we've had a small pullback in this last week or so, and we've got oversold conditions as of Friday. Now, what's important for us is that the base looks as though it's nicely in place. The 20-day and the 50-day moving averages are both moving to the upside. The 20 has crossed the 50, and this is the first oversold reading that we've had since that bullish crossover. This historically, in any market, is a good spot to find an important low from which to stage a more prolonged move on the upside. So definitely looking at this as a bullish position for the U.S. dollar.
What's happening with the Canuck buck?
Canadian dollar had a decent bounce here. We are now sitting around 71 and change. Resistance is at 70, just shy of 72. And as far as I can see at this point, the trend probably is still down. We got oversold a week or so ago, but overall, if the crude oil market's going to be under pressure, I think the Canadian dollar is also going to be under pressure. So no point in being bullish on Canadian at this point, especially if the U.S. dollar is showing the basing action that we see for now.
And Ross, another special offer for our listeners.
Yeah, we're going to continue this. This is a Thanksgiving special, 25% off for new subscribers. So you can find the link on our website at chartsandmarkets.com.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on X at Charts by Ross. Coming up, Eric Hadik, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, well, thanks for having me back, Jim.
Eric, can you tell us a bit about Inside Track, spelled with two I's, and how our listeners can subscribe?
Yeah, Inside Track is a financial and commodity futures market advisory service. Also provides a lot of technical training tools and tutorials with a heavy concentration on cycles, cycle progressions, and the timing of swings in the markets. Your listeners can find out a lot more information and view many examples and subscription options at our main website, InsideTrackTrading.com, and that's spelled with the two I's in the middle, so it's INSIIDE, TrackTrading.com.
It looks like President Trump wants a much lower Fed rate. Does this push by President Trump affect the interest rate cycles and possibly stock market cycle?
I don't think that it alters them as much as fundamentals like that will reinforce the cycles. And as you can see, there's a lot of pushback against that. In fact, just over the last week or two, we've had a couple of the Fed governors come out and say that they need to see more justification for any further rate cuts. And so it's an ongoing battle, so I don't think that it really has much impact on the broader cycles. My work is still showing that bonds and notes could wait until the first quarter of next year before setting a high, so that would be a corresponding low in interest rates. And regardless of what the president is pushing for, I think the markets and the market fundamentals are going to come out the winners, so those cycles remain intact.
Since we last talked, the Dow hit new all-time highs, pulled back, and looks to be moving higher. What do your cycles see ahead for the Dow and the other U.S. stock markets?
Well, I've been saying all along that I thought we would see a series of highs in the second half of the year. And that comes after we fulfilled the downside projections for the first 3 to 4 months of 2025. And since then, the market has been showing that it needed a rally to one more set of new all-time highs, and that on an intermediate basis, we should see some significant highs in late July, then late September. and all part of a topping phase where we would see divergence among the different indexes. So even as the industrials are spiking to a new high, other indexes, the S&P Mid-Cap 400, and really leading the way right now, the NASDAQ 100, are showing that this is likely a divergent high where they are likely to see lower highs set right here on November 11th, 12th is when my work was showing, and then see another sharp sell-off leading into the second half of November. And even on a shorter-term basis, I came into the month telling my readers to look for a pair of sell-offs. The first one should be into November 7th, and there was a myriad of daily cycles and timing indicators showing that we should see a short-term low set then, but then after a 3 to 4 trading day bounce, that the indexes would be ready for a new decline, and one that could do a bit more damage than the early month one. I elaborated on this in my midweek alert yesterday and just reiterated some of the very unique and uncanny correlations that are occurring in the market, and why on a near-term basis I thought that bounce into yesterday, the 12th, would likely result in a new downturn starting today. So my work is showing that we're going through a topping process and that each of the subsequent sell-offs will probably intensify and increase in their magnitude.
Is the Dow Jones transport cycle an important one to watch?
The transports often lead some of the bigger turning points in the market, and so I certainly watch them as kind of a canary in the coal mine type of scenario. You can even go back to the late 90s, early 2000s, and you see that the transports led that turnaround, and they've led many of the big reversals, both from a top reversing down or from a bottom reversing up. They've often led that, so I do keep a close eye on them.
Are the cycles turning up for the U.S. dollar?
Dollar cycles definitely bottomed on a 3 to 6 month basis in early July, and the dollar kind of reinforced that in September with a secondary low. I think that this is more of a larger magnitude rebound in a broader overall decline, but I could see the dollar waiting until January before setting a final peak to this consolidation and this bounce. So I don't think those cycles have turned significantly higher, but that we've had this 3 to 6 month bottom that has created an ABC rebound to the upside.
Is the Canadian dollar likely to show any strength soon?
The Canadian dollar has been kind of hovering around some key support levels, but I haven't seen any strong indications of a reversal higher yet. What I'm really looking at, and I've been kind of monitoring the March 2026 futures, I need to see the Canadian dollar get above 72.50 before I would think that it has put in anything significant as far as a bottom.
Bitcoin peaked October 5th at over $126,000 US. Since then, Bitcoin has pulled back below 100,000. What are you seeing in the Bitcoin cycle?
Bitcoin is in a very interesting position, I think, from a market perspective. And I've been describing this since early this year and telling my readers to look at late 2025 as the time when I thought this scenario that I've been describing would really start to kick in. And before really elaborating on that scenario, I'll first answer your question about Bitcoin itself. And my work has shown for over a year that Bitcoin should see a final, and when I say final, I'm talking about 6 to 12 months peak in the second half of 2025. And when we peaked a little bit above 100,000 and then pulled back to almost 75,000 into April and started to recover from there, I explained why I thought Bitcoin could get up to a strong convergence of upside targets and wave objectives and what I call range trading targets, all of which were grouping at 125,000 to 127,000, and that's where I thought we would see a major top. And in early October, you saw Bitcoin retest its highs while still holding the peak that was set in July. And when I say holding, I mean on a weekly and monthly close basis, which is what's needed to validate some of those reversals. And it gave some pretty convincing sell signals in the first half of October. And right after that peak, within days after the peak was set, I had published in one of my weekly relay alerts where everything in Bitcoin was showing me it should see a quick initial drop to 100,000 and a little bit larger overall drop to 80,000, maybe getting down to 75,000. And so that has been my outlook since the first half of October. And I've diagrammed why I think this is the case from a technical, cyclical basis, but also described why I think from a fundamental basis that the bull market is has run its course and needs to go into a larger corrective phase before there would be the chance for any additional impulse waves to the upside. So I think that Bitcoin, like you said, last week we had that spike down to about 99,000, and then this week we've bounced to 106, 107,000. And again, in this midweek alert that I sent out to my subscribers yesterday, I described why I thought it was ready for another sharp sell-off. It's going through what I call my daily 21 Mac reversal sequence, and both Bitcoin and Ether, with their early week rebound, have come right to declining resistance. And that's why I think that right now, November 13th, 14th, into the 17th, maybe 18th, we could see another sharp bout of selling, and that could begin to trigger the broader scenario that I've been describing that I think will ultimately have a significant impact on the stock market and related markets.
Gold hit new all-time highs in October, then pulled back. What are you seeing ahead in the gold cycle?
The gold cycle is the same that I've been describing since over a year ago, that I think you have gold and silver. We're both looking for a significant peak in late October. In the case of gold, that could be a more significant top, whereas silver was showing me it should only be a stepping stone on the way higher into March or April of next year, when silver and the white metals have more significant cycles. But ever since early April of this year, I've explained why I thought that platinum and palladium and silver were all ready to enter major bull markets, and that those bull markets should stretch into the second quarter of 2026. And in the case of palladium, it could even go a little later than that. So all of that is still very bullish from a broader perspective. But I think that gold in particular has entered a multi-month corrective phase after fulfilling those late October cycle highs.
Silver hit new all-time highs in October, then pulled back. What are you seeing ahead in the silver cycle?
Silver, as I said, I think that it's in a little more bullish technical and cyclical basis than gold. And I think that silver still has additional highs to be seen next year. But really this time frame surrounding mid-November is going to tell me whether the October highs are going to hold for very long, or if silver is ready to move on to progressively higher highs.
Platinum and palladium both peaked in October and have since pulled back. What's likely ahead for platinum and palladium?
I think that those other white metals are still in a very positive and constructive overall cycle, and I think that after a significant correction that we'll see them head higher into next year. There's actually some multi-year and multi-decade cycles I've described in platinum and palladium that come back into play next year and could time a very important peak. But those types of cycles are often the culmination of a parabolic move higher. So the actual levels where those highs could form are yet to be determined.
It looks like crude oil put in a bottom in October. Is crude likely to continue to move higher?
I think that crude oil has been in a bit of a divergent situation between it and the products, namely heating oil and unleaded gas. And I described in August and September why I thought late September would see a multi-month peak in crude, and that crude could wait until January of 2026 before setting a final low. But at the same time, I explained why the technicals, particularly in heating oil, were much more positive. And what I laid out then that I expected was to see a series of higher highs in heating oil with lower highs in crude during each of the intermediate intervening cycles. And then when you saw sell-offs from those highs, you would see higher lows in heating oil, so an uptrend line, and lower lows in crude. So even though you're getting highs and lows at the same time during the same cycles, you've got an entirely different price structure and wave structure unfolding that has different ramifications for the weeks and months that follow.
Natural gas bottomed in August and has been moving higher. Are natural gas cycles looking bullish?
Yes, I think that natural gas has entered a bit more of a bullish phase that could ultimately stretch into March of next year. And it is starting to give some technical confirmation to that, some pretty good signals that were set recently. But there still is one or two key indicators that need to turn fully positive for me to get behind natural gas with a more convincing bullish conviction. And one of those would be to see a weekly close above $4 in the March 2026 natural gas futures contract. And a couple others involve some evolving indicators that I watch. So each week the level is different where a confirming signal would be triggered. But natural gas is set up to where in the next couple weeks it would have the best potential to turn those signals positive.
Food's a big concern. How are the agricultural cycles looking?
Well, that always depends on which food and which ag market you're looking at because they're very diverse. And if you look at the grain markets, I've been thinking that we're seeing a major bottom start to take hold. I've explained for the last several months why I thought that soybean had a major shift expected in August and September of this year, and that if they set a bottom there, ideally during August, there were these 4-month and 12-month and multi-year cycles all coming into play then. And if they subsequently held that low, that it would indicate soybeans are in the early stages of a new bull market, and there are some significant cycle convergences out in 2026 that give me a better indication of how long and to some extent how high we could see soybeans move during that time frame. And you've also had corn start to give some bullish indications. Wheat is taking a little longer, but wheat may have some of the best potential from a percentage basis upside move, but it still needs to generate some additional bullish signals to validate that scenario. As for other ag markets, livestock showed a peak in recent weeks and or months, and so I think that they're on the other side of a top, and you've got your softs all giving mixed signals as well, some in more bullish, some like sugar and even cotton are getting closer to significant bottoms. So it's a mixed thing out there, but I think the grains are one of the interesting agricultural market that I'm looking at, and the potential for a more substantial and long-lasting bull market.
The lithium ETF, LIT, bottomed in April and has been trending higher, doubling in price. What do you see ahead for lithium and the battery stocks?
Well, they're, as you kind of alluded to there, they're two entirely different things. The price of lithium and the stocks. I know we discussed this 6 months ago and even more, and basically what I said then and still contend is that the LIT ETF trades like a stock. So it's following the stock market cycles more than it is the actual price of lithium. And so it bottomed in early April right along with the stock market and has been moving progressively higher, just like the stock market. And so I'm watching as much stock cycles for the LIT, and it's showing me that it could be nearing a significant top. As for lithium itself, that's still in more of a bottoming phase. So you've got that dichotomy, that paradox between them. But I think that the LIT, it's reached some key upside objectives between 64 and 67, and that it could set a peak up near those levels.
Before we go, Eric, anything else we should keep a close eye on?
Well, the one thing that I kind of alluded to earlier when I was talking about Bitcoin and the stock market, and it's something that I started describing earlier this year, and I thought that it wouldn't really come to fruition until after Bitcoin cycles peaked in the fourth quarter. And so when Bitcoin cycles were turning down in November, December of 2025 is when I thought that this should be paid much greater attention. And it's a scenario that I have described as possessing some eerie parallels to the 1920s and to the 1990s. And the parallels that I'm referring to, and that doesn't automatically mean I think the sky is falling, but those parallels are where you get a runaway bull market, and then you start to get derivatives and derivatives of derivatives, and you get to the point where the tail is wagging the dog, so to speak, in those markets. And the correlation that I made back then and continue to monitor is how Bitcoin has now taken on a life of its own, and you've got major corporations starting to stockpile Bitcoin as part of their holdings. And, one stock in particular has been at the forefront of that strategy. And the problem with that is that's great on the way up. That's great when you're compounding the gains in a bull market. But with any type of thing where you're almost parlaying, you're taking present gains and just rolling them forward, doubling down type of scenario, that it doesn't take near as much of a drop to wipe out all of those gains and then enter into a very precarious period and position. And that there are some parallels. Again, I'm not saying it's exactly the same. Cycles rhyme, they don't repeat. But there are some parallels where I think the sell-off that I've projected for Bitcoin from early October into the second half of November, into the early part of next year, and then ultimately into some monthly cycles that I've described a little later in 2026, that at some point it's going to hit this point of critical mass where the losses in Bitcoin start to have a very adverse effect on some of these companies that almost modeled themselves after a pseudo Bitcoin ETF. And so by holding a bunch of Bitcoin, then people buying their stocks were also buying a proxy for the price swings of Bitcoin. And the reality is they are buying that, but that doesn't do well when Bitcoin is heading lower and when things have been bought on leverage or, like I said, parlayed to where you have a higher percentage of your purchases at the higher prices. That means it does not take near as much of a decline to wipe out a significant percentage of those gains. And then you get into scenarios like you saw in those past bull markets and even bubbles where the sell-off begins to feed on itself. And right now on a near-term basis, since this early week bounce to 107,000 in Bitcoin, I think that it could drop to 91,000 pretty quickly. But there are lower objectives in my work below that. And I think that some of these companies that are proxies for Bitcoin are going to also start to hurt. And I don't know if you would see any of them after a period of time. I mean, Bitcoin would have to stay lower, which is what you often get after a sharp sell-off, just kind of some consolidation. But the longer that it stays well below its highs, the longer that those Bitcoin holders are forced to decide whether they're going to keep holding or whether it's time to start liquidating some, and then you get a bit of a snowball or a domino effect. So that's something that I'm watching very closely and have been talking to my readers about and been focused on this fourth quarter of 2025 all year long for this thing to begin to take hold. So we're here, and I'm looking at this, even this very immediate time frame, just today, the 13th, the 14th, 17th, and 18th, as being a vulnerable time for Bitcoin, and as a result, a vulnerable time for the stock market, in particular the NASDAQ 100, where we could see a sharp sell-off.
Eric, where can listeners subscribe to Inside Track spelled with two I's?
They can go to our website at insidetracktrading.com. And like you said, it is inside with the two I's in the middle. So that is INSIIDE tracktrading.com.
Eric, thank you so much for being on This Week in Money.
Thank you for having me back, Jim.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also works for MacBeth.McLeodPartners.com in Edmonton. Welcome back to This Week in Money.
It's a pleasure to be on the show, Jim.
The second edition of your book, When the Bubble Burst, is on sale now. Can you tell us about it and where people can buy it?
Yeah, they can buy it everywhere in the top bookstores and online with Kobo and Kindle and all those places. And in the book, I talked a lot about the problem that in Canada being addiction to debt connected to housing, and that's turning out to be the major factor as we get into this bursting of the bubble that we're going through now. So it's a very timely read.
What's the latest on housing markets in major Canadian cities?
Well, the major markets of Toronto, Vancouver, of course, Toronto especially, and it's grim. It really is. There's one property, and like these single family homes in downtown Toronto were expected to hold up better than the suburbs, and yet this thing was listed for $3.6 million. Now I don't know if that's an accurate assessment of what it was worth, but that's what they asked for it about 3 years ago. Kept dropping the price. It finally sold for $1.8 million. So that's a huge coming down to earth reality check. And the average single-family home in Toronto was up as high as $1.4 million, and now it's down to about $1 million. So I'm using round numbers to make it easier, but that's not quite a third of it's under 30%, but around there. So now if you include inflation in there, it's even worse, of course. But and the other thing is the amount of inventory that's sitting there. There's a tremendous amount of inventory. The GTA's got something like 20,000 or more new condos that are pre-construction condos that have been bought, and the people won't be able to close on them. So they've committed to buying them, but they can't close on them. And there's something like 26,000 listings in the Greater Toronto area of properties. And I don't know how realistic the asking prices are, but every month there's more listings than there are. Sales are very slow, and there's more new listings than there are sales. So the number of listings keep expanding as they add more listings, even going into November, December, which is the slowest part of the year for real estate sales. So these must be desperate people. And in Vancouver, it's a little less dramatic. It's more like 10 to 20% decline. And there's a lot of empty condos sitting in Vancouver, completed and empty. Something like 2,500 sitting empty. So that'll be good for renters because, the owners of those places probably will end up renting them out. Rents have come down. Not as rapidly as people would like, of course, but there's a lot of downward pressure on rents now. And but one of the most interesting aspects of the national market is that all through this period, and I take the last 20 years, basically, the investment in real estate in Canada stayed 8 to 10% of GDP. It got as high as 10 briefly in 2023, I think it was, and now it's back down to 8%. Which is a huge percentage of the economy. In the U.S., it peaked at 6% before the global financial crisis, before the big short, and it went all the way down to 2%, and now it's bounced back up to 4%, which is more normal. So we've been well above normal, like double normal, for basically 20 years, from 2006 to 2025. And now a lot of that that spending is new construction, renovations, and of course, realtors' commissions go in there, land transfer tax. So even realtors' commissions and land transfer tax have been as high as 2.5% of all GDP in Canada. I don't know why it's counted in GDP, because it doesn't sound very productive to me. And the P in GDP is production. But at any rate, people have really invested a lot in real estate in Canada. In my opinion, as I wrote in the books, overinvested. And now we have to bear the burden of it because, of course, associated with all that overinvestment is the debt that goes with it.
Are banks getting concerned and making it harder to get a mortgage?
Well, the banks are like 75% of all mortgages in Canada are held at the banks. So those are assets. For the bank, they're an asset. For us, poor debt slaves, they're a liability. But for the bank, they're an asset. And so that a huge portion of their assets, as much as 50-60% of their assets, are in loans to the household in Canada. And the household in Canada, by the way, is over 100% of GDP. It's one of the top 3 in the world. Australia might be slightly higher than us, but we're right up there. And so the banks can't just turn their back on lending to the households. And most of the lending, 75%, $3 out of $4 goes for mortgages because they're not really big on lending to people who don't have real estate as a collateral to offer, unless they've got a really good job like a doctor or something, like a dentist or something like that. So the most of the bank's business has been real estate mortgages, line of credit. They lend to developers, though they're pretty cautious about that. And now that that's starting to slow down, of course, with all these unsold homes on the market, it'll be a huge change for the banks. And of course, the number of consumer insolvencies have ticked up. I think in BC, I saw that it hit a new record high, even higher than it hit in 2009. Now, 2009 in the U.S. was a horrible crisis. In Canada, it wasn't such a big crisis, but still, it's an indicator that defaults are still low. They're 0.1% at the bottom, and they're up to 0.2%. So they've doubled off the bottom, but they're still well under 1% of the total. In a full-blown crisis, consumer insolvencies, bankruptcies would get up to 1%, and that would hit the banks very hard because they've got a lot of leverage in lending to households. So they're going to tighten their credit. But on the other side of the coin, governments realize that that's an important part of the economy, a big sector in the economy, and they're trying to encourage them to do more. So one of the places that they're encouraging lending through CMHC is for what they call purpose-built rentals, which are apartment buildings, and those are being built like crazy all across Canada, and that'll bring rents down, which will bring house prices down, which will be a good thing for affordability. But it takes a while to get all that built.
In British Columbia, a judge awarded Cowichan First Nations land that is fee simple private property that includes multi-million-dollar mansions, blueberry farms, a golf course. To buy or sell properties here, you now need approval of Cowichan First Nations. Banks will not mortgage properties there. Land grabs by First Nations in BC and Quebec are already spreading. Could this trigger a Canadian real estate crash?
I don't know the specific details of Richmond. I did look at the story, and I understand there's 45 properties involved. But the bank that was involved also stated that the land claimed by the Cowichan band was not a factor, and they're turning down the loan. But in general, though, if you wanted to look at the whole situation in Canada, Canada's been recognized as a very stable place for lending for real estate. That's why the banks are so heavily involved, and they're probably more involved in lending for real estate in Canada than they are anywhere in the world except perhaps Australia. And the common law, obviously, is the major law in lending for real estate, going back to hundreds of years, back to England, English common law. And maybe that's why people feel so comfortable about lending for real estate, because they can always use these common law principles to seize the property if the person defaults on the loan. So this new angle with the with the Aboriginal titles. Of course, everybody knew that most of BC had not been, there had been no treaties made for who owned the land and how that was all divided up, unlike Alberta and Saskatchewan and some other provinces. So BC was always had a bit of a question mark over it. I mean, people were going along merrily, enjoying thinking about it as something that they didn't need to worry about. Now, perhaps they do need to worry about it, but it's a terrible thing because we now have 4 levels of government. Before we had 3 levels of government. 3 levels of government was already too many levels of government, and now we got a 4th level of government. And it's as if we care about Canada staying as a prosperous nation, we need to do something about all these levels of government and the conflict between them. And I don't know what the solution is. I really don't. And of course, the courts are going to apply the law as they see it. But just to, sort of on a different topic, but related, the Columbia River Water Treaty, that's not the exact name of it, but it's the treaty between the U.S. and Canada. It expired in September of this year. And they've got a 5-year period where the existing treaty conditions continue. And then they have that period to try and negotiate a new agreement. But that could be very, very interesting because I think it was a 50-year agreement or something that goes back to the 1960s. And so when it's renegotiated, in the 60s, they kind of ignored the Aboriginal land claims, the Indigenous land claims. But this time around, they're not going to be able to ignore it. So it's going to be quite interesting to see how that all... the discussions have been going on for quite a while. They started talking about it more than a year ago with the committee, but there's been no announcement of any kind of a agreement as to how to divide up the water. But of course, we know that the U.S., in parts of the U.S., is getting very, very short on water. That's going to become a very big issue, more than just a few properties in Richmond, BC.
Treaties were signed in Alberta in the late 1800s. Will this make Alberta immune from the uncertainty over land title that's going on in British Columbia?
Well, it certainly makes it safer than what we just talked about. The treaties were signed. They were agreed by the British Crown before Alberta became a province in 1905. And land titles have been pretty well stable. It was interesting. If you were a settler, the deal was you got the mineral rights to your land. And so all this oil and gas that's been discovered in Alberta, there's a very, very few number of people that own the mineral rights themselves. In Texas, pretty much everybody that buys land in Texas gets the mineral rights, but in Alberta, most of it, the oil rights are owned by the Crown, because if you were a settler and then you sold the land outside of your family, you lost the mineral rights. They reverted to the Crown. And most of this happened before 1947 when the big discovery was made in Leduc of the oil and gas. So people didn't realize how valuable those mineral rights might be. So, but yeah, there's a lot of things. I know of at least 2 huge fortunes that were started by going around and buying up those mineral rights from those farmers. And they didn't know what they were selling. They didn't know what they were letting go of for a few dollars. And the story is that the landman would bring a bottle of rye whiskey and put it on the kitchen table and talk to the farmer and convince him to talk him out of his mineral rights. And I don't know how true that is, but anyway, so yeah, this land thing, it's a big deal. But there's a tremendous amount of Crown land in Canada too that's never been privately titled either. So, it's a huge, vast country, except when you get into the very, very crowded part of the lower BC mainland and maybe around Toronto. Most of the rest of the country has got lots of room.
What are your thoughts on Canada's 2025 budget?
So the budget came out. It was heralded by the Prime Minister as a game changer budget, but I think it fell short of that. I didn't really see. I actually didn't read the 450 pages. I have to admit. I don't know if anybody did, but it didn't come to that up to that mark of being a new departure for future economic growth. The big thing I think that came out was that the budget deficit was going to increase from 40 billion to 80 billion. Now, it sounds like a lot, and it is a lot, but prior to COVID, but then after COVID, when it hit 500 billion one year, 80 billion doesn't sound so bad if you say it quickly, but it still is a very high number. It's less than 5% of GDP. In the U.S., they've been running 6, 7, 8% of GDP now for some time. So I think it's probably manageable for Canada, especially given that Canada still has its AAA credit rating. Although there is some talk now that we might be losing it. There are very few G7 countries. I think only Germany and Canada still have the AAA credit rating. So the debt doesn't seem in the government to be as bad as a lot of the stories you see, especially in some of the more right-wing newspapers talk about it. But it is a problem, given that the bill for the assistance that's probably going to be needed with the bursting of the housing bubble. That bill has not been presented yet and hasn't been paid yet. So that's going to be a big expense. And of course, CMHC guarantees the mortgages that are underwritten by it. And then there's two other mortgage companies that also have a quasi-government guarantee on their mortgage insurance as well. So as most of your listeners know, but I think a lot of Canadians don't know, the mortgage insurance is not for the homeowner, it's for the lender. So the institutional lender gets to claim the insurance if they lose money on their mortgage. And there's been very little loss so far. It's been pretty minor, but it's going to ramp up pretty quickly. When you get the prices going from 1.4 million down to 1 million, that's going to cut into the amount of money that's available to pay off the mortgage and leave a loss at some point. So we're going to start seeing that coming up, and that is not in the budget. Of course, the other thing they talked about in the budget that sort of caught my eye was they wanted to do something about money laundering, but it was pretty minor. It was they were talking about cash deposits of more than 10,000 being prohibited. But really, it's not cash deposits. The Peter German report in BC that looked at Vancouver money laundering talked about a peak of 15 billion a year just in BC alone, and so there's no way that's cash. That's wire transfers and that sort of thing. And usually, what it is, it's corporations moving money without disclosing who the beneficial owners are in the actual corporation. So you got your directors of the corporation, you got a lead director or nominee director, and the domicile of the actual true owners of that corporation is never disclosed. So there is a project underway in some provinces. Now this is a problem because it becomes provincial versus federal jurisdiction. But in some provinces, not in Alberta, I don't think, but in some provinces, maybe Ontario, there's a move to bring in full disclosure under numbered companies as of 2027, I think. And that'll have a big impact on money laundering and that sort of thing. But of course, money laundering, you're closing the barn door after the horses have fled, because the big years of money laundering were sort of from 2000 to 2021 kind of thing. And I think most of the money laundering is really settled down now. But it'd be nice to know who owns all these corporations that are running money through Canada. And but of course, there's a lot of people that, for a lot of people in the system, whether it be the lawyer, the realtor, the bank, the homeowner, the developer, these people that are using these numbered companies to run money through are some of their best customers, of course. So they're very reluctant to agree to these new measures. The other thing that's unusual in Canada compared to other countries is because of a ruling in BC, the lawyers were not required to disclose who their client was under lawyer-client confidentiality. In most other countries, they are required to, but so they left it to the Law Society, British Columbia Law Society of Alberta, to monitor those transactions, but they're not very good at monitoring them. So there's talk about trying to make a change under that one as well. So that would be a big help. So I don't know if that's going to help it's not going to help the real estate market prices stay high. It's probably going to help them come down faster. And but in the housing market, they did talk about building more housing. And but it's modular housing. It's not going to be a huge impact either way. Really, in the end, there isn't that much the government can do, other than probably push the banks a little bit to stick to their rules a little bit more closely, and bring the requirements, tighten them up a little bit, so that people don't get into more debt than they can handle. And that's happening now, I suspect, and that's going to be a key factor in bringing house prices down, which will make them more affordable. So there's like a whole bunch of people that don't want house prices to come down because that's their major asset for retirement. But there's even more people, probably younger people, who want prices to come down so they can buy their first house. So I think in the end, the house prices will come down to the point where people will be able to afford to buy a house again. But they got quite a ways to come. There's, we've had a nice drop so far, 20-30%, but there's at least that much work more to do, both of the same magnitude, to get it to the point where people really can afford to buy a house.
The vote on the Canadian budget will be November 17th. Do you think the Mark Carney Liberal government could fall?
I don't think so. No, they've already picked up two. They picked up one crossing the floor. I think they only need 3 or something like that. So one guy resigned. I don't know what that means. I guess that means he can't. Actually, I think he hasn't resigned yet, so he still might have a vote with the Conservatives. But to bring the government down, it would require either some Liberals to defect. That's probably not going to happen. Or all of the opposition members to vote against the budget. All the NDP, all the Conservatives, all the Quebec parties. It would be impossible to get them all to agree on one thing unless they were really, really upset. And of course, the Conservatives don't want an election because they'd have to go into the election with their current leader, and he's up for a leadership review at the end of January. So I would think that it'll be one of those things where they're really upset with the budget, and then when the day it comes to vote, somehow mysteriously a couple of them don't show up and the thing passes. So.
Build Canada Homes, the government getting into home building. Is this a good idea?
Well, it's interesting. The affordable housing. I was reading about the condominium market. The whole idea was you get a condo in your 20s, and then you got your foot on the housing ladder, and then eventually the condo rises in value to where you can buy a house and all that. That didn't work out because the condos they were selling were not meant for people to live in. They were meant for investors to speculate with. So the type of and of course single family homes were never built for affordability. They were built for wealthier people or older people. So with maybe the exceptions in Calgary, Edmonton, Regina, and that sort of thing, but in the big centers, single family homes were really just never a factor. So I don't know how much this government program, how much impact it's going to have, but the only way that affordable housing ever got built in the last 100 years, I guess, was with the heavy involvement of the government. So after the Second World War, the government got very involved building, they still use private sector contractors, but they went ahead, made sure all these homes got built for these people that wanted to form families after the Second World War. And it worked fine. I mean, there's a whole bunch of homes in Edmonton just still sitting there. A lot of them have been renovated, but a lot of them are still the way they were. And they're not very big. And but you got a home, you didn't get a garage. Your basement was unfinished. There was like a 1.5 story house, where the top half was not, the ceilings were slanted, but there was room for 2 bedrooms up there for the kids, I guess. And they were cheap and they were affordable, and that's what people got. Everybody got them. You know, it doesn't matter how good a job you had or how bad a job you had. Everybody started in those homes. So that was all that was available. So if we could do something like that, that might be interesting. But I don't think that's what's going to happen. I think what's going to happen is the immigration, non-permanent residents, which was getting up to a ridiculous, like 3.5% growth per year, compared to the long-term average, which is about 1% population growth, flooded the market, and a whole bunch of stuff got built. And now that growth has dropped right back down below 1% again. The forecasts in the budget were 0.5% for 26 and 0.5% for 27. So that's going to really impact the availability of housing, make housing much more available. Because as these what used to happen with non-permanent residences, you had a 1 or 2 year term, and a lot of times you'd get permanent residency at the end of that term. Now they're not giving that out as nearly as easily. So a lot of these people have to go back wherever they came from because they can't get their permit renewed, and that'll slow the demand down for housing quite a bit. And then we'll find out that the existing housing supply might be pretty good. It might be good enough.
Eliminating the underused housing tax of 1% that mainly targeted foreign owners, is that likely to attract more foreign home buyers?
No, it could. I think I think there's bigger factors going on though. I think the like a lot of things, they used to talk about hot money, and you'd get these hot money inflows going from country to country, and it was true. And a lot of times these people had money that, for whatever reason, way beyond what they wanted to invest in their home country, and they wanted to spread it around. In the case of Iran, for example, there was a takeover after the Shah was dethroned in 79 or something. And a bunch of private sector people had money, came out and wanted to distribute it into other countries like safe havens like Canada and stuff. And same thing happened with Cuba. A bunch of private landowners in Cuba that had to get their money out of Cuba when Castro took over, and so on. So in China, the story was that people were trying to get some money into Canada because it was safer to keep it here, because you never know what was going to happen to the Chinese government in China. They wanted to have an option to invest some money here and then have a citizenship maybe to go to as well. Now that's, in the case of China, that's changing because China is actually looking like a better place for economic growth right now than Canada. So it's I think it's changing. So the push factor at home, whether it be Iran or Cuba or China, maybe isn't as strong as it was, but also the pull factor is not as strong as it was either. Canada's not viewed as a shining light on top of the hill anymore. People are not being attracted here because they don't see the growth opportunities that they were seeing. But the big thing is when house prices start to drop. So a lot of those people that were rushing in with money to buy houses in Vancouver, for example, they didn't really care if they paid more than the market price because they assumed that prices would just keep going up forever and eventually they'd be fine. But now the prices have slumped we're just about to start into our 4th year. January 2022 was sort of the peak. So January 2026, that'll be 4 years of sideways to lower prices. A lot of that, those people start to drift away they look for other places to go. So a 0.5% tax isn't really going to make that much difference to them. They're thinking about bigger things. And I think those minor tweaks, that's probably why they got rid of it. It just they weren't collecting it. It was costing more to collect than what they were receiving, and it's just not worth it.
The federal budget includes banning cash transactions of more than $10,000. Is this another step on the war on cash?
I don't think it's a step on the war on cash, but it's certainly kind of ridiculous because, everybody knows that you don't walk into a casino with a bundle of cash. And that's the one thing that on the money laundering spectrum that you could get caught for. So I think that's the thing that bugs me when I see things like that is to say they're not really attacking, as we talked about a minute ago, about where the real big monies and the billions of dollars is coming in is through the financial system. We have banks and credit unions and everything. And usually it's a corporation, numbered company. It's maybe through a lawyer's trust fund or something like that, and large sums. There's no cash involved there. It's wire transfers, and there's just not the scrutiny that there needs to be. So that seems like one of those little for show items that isn't really going to have any impact in my opinion.
In the budget, establishing a financial crimes agency, from what we hear, money laundering is everywhere. Could this be used to target enemies of the government?
Well, this financial crimes agency is long overdue, and like as we've been discussing here today, there have been rules. I worked for 46 years in the financial industry. Every year, I had to take recurrent training on how to recognize suspicious transactions, and then it was my duty to report it to the supervisor. And then the supervisor would report it to somebody in head office. And they would decide whether to report it to the agency that monitored that. So there is a monitoring agency for suspicious transactions. But the problem is you get all these suspicious transactions and then nothing happens. So the way it was set up before was, up till now, is that agency that was getting those reports would have to decide if they wanted to investigate further. They didn't have any investigative staff, so they had to go to the RCMP. The RCMP wasn't really that interested in these financial crimes. So there was really nothing happened. So these just kept building up all of these reports, suspicious transaction reports, and nothing was ever done. You can see it because you'll notice, in the last 15 years or so, since I've been watching this closely, there's been multiple arrests and investigations done by American authorities on things that happened in Canada. But there hasn't been one single one that I'm aware of that's been initiated in Canada. So, and there's been at least one that in 2017, Home Capital, that should have been investigated, but the Canadian authorities decided not to do anything. So TD Bank's an example. Now that happened in the U.S. There was an example of money laundering in a bank branch in the U.S., multiple bank branches, and it was the U.S. authorities that got them, and they got heavily fined and they're under some very heavy restrictions because of it. And but in Canada, we tend to be too timid about these things. Nobody wants to rock the boat. So maybe this is a start of something. I don't know, but we're going to have to get a lot tougher with these things. But whether they be targeting the enemies or not, I don't know. I think they'll probably just target the bad guys. And of course, they cost a lot of money to do these investigations. And one of the problems with financial crimes is if there's a jury, you have to explain it to the jury. It's really difficult to explain it to the jury. And a lot of times they don't get convictions in the end. So they're really reluctant to go ahead with it. But we need to do something because there obviously is a lot of financial crime going on in Canada, as there is probably everywhere in the world. But the difference in Canada is we don't prosecute it nearly as much as other jurisdictions.
In the budget, adding a regulated space for stable coins. Could stable coins just be another name for central bank digital currencies?
Well, stable coins. So now I'm getting outside of my expertise here, but stable coins are designed to be tracking the value. Kind of like the idea is to sort of keep some kind of stability, like the word stable implies. With a cryptocurrency, because one of the big criticisms of crypto is the volatility. So you can't really use it very well for transactions, that sort of thing, because the price movements are just too large on a day-to-day basis. But they're anything but stable. I mean, they're not stable. Like there's been several major crypto personalities that have gone to jail. Bankman-Fried is the one that thinks, and he had like an idea of these equivalent to a stable coin, in his thing. And the idea was that there would be backed by government, U.S. government treasury bills. So there would always be but of course, stuff happens and the backing turns out to not be there. So what I don't understand is why people don't just keep their money in the treasury bills to start with and skip the stablecoin altogether. So I'm not as concerned about the digital currency as maybe I should be, because it doesn't seem to me like it's a big thing yet. Not likely to become a big thing. The big thing that's happening right now is gold. Gold is, which I have been interested in for a long time. You know, I've talked about it many times, and it's doing phenomenally well. The gold price is at $4,200 an ounce, and our mining companies, as I mentioned multiple times, I preferred to buy shares in mining companies because you get the gold price lift, but you also get the increase in reserves because of the way the accounting for ore reserves works in the mining business. As the price of gold goes up, the gold company can revalue its reserves. Hey, I got way more. Before I had 10 million ounces of reserves and I'm producing 1 million a year, so my mine's going to last 10 years. Now I've got 30 million ounces because I'm allowed to count these somewhat less attractive reserves as real, now that the price of gold is $4,200 an ounce. So they're reporting they finally have started to report some really good profits in share prices. Now, so far share prices have doubled, but I think they probably have a lot more to go.
In the budget, consumer-driven banking with economy-wide data sharing, what could go wrong?
You know, I don't know when the last time you've been in a bank, but it's so funny. You know, you go to the bank, and I had the unfortunate task of being an executor on relatives' estate a couple of years ago, and I kept going to the bank, and they'd sit there and they'd have this tick, 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 all these keystrokes they had to do to get into your accounts and stuff. And this is like from the 1960s. This is IBM, type COBOL-driven type computers, and the idea that we could move to something faster would be very, very nice when you think about it, because we're being held back by those computer constraints. But I don't know what's going to happen. The problem the big banks have is they got a couple of problems. One is the people that know the computer programming languages from the 60s are dying. Young people don't want to learn them, and that's number one. And secondly, they can't figure out how to replace them with something newer and more advanced, because they can't really shut the bank down for even really hard to shut it down for more than an hour or two at a time to make the changeover. So somebody will come along and disrupt the banking industry. When Elon Musk first got started, in his predecessor to PayPal, that was actually his mission. He was going to disrupt the banking business because he was so upset how stupid they were. And he had been working at a Canadian bank, so he knew how stupid banks could be in Toronto. And he went to the U.S. in San Francisco, but then he sold that company and got involved in electric cars instead, because he thought that was more exciting, I guess. But we're still floating around with Visa and MasterCard, PayPal, and all that stuff. At some point, something hopefully would happen. Because, when I started almost 50 years ago, the banking industry is like 5% of the stock market. Now it's 25% of the stock market. But that whole segment is a cost to all the rest of us. Like there's no value added there, or very little value added. I shouldn't say no value. There's some value added as a convenience thing, but we're paying an enormous price for some very, very old technology in that sector.
Projected deficit of a record $78 billion, and the government is projected to borrow $594 billion in 2026-27. Annual interest payments are around $55 billion. Is Canada headed in the wrong direction?
Well, it's headed. Let's say it's headed in the same direction as everybody else. So it's kind of like it's one of those things. You don't need to be perfect. You just need to be not worse than your neighbor, kind of thing. In this case, the neighbor being the United States, and we're definitely not worse than them. They're worse than we are. Our tax rates are about the same corporately as their tax rates. Our personal tax rates are a little bit higher than theirs are, but as a percentage of GDP, as I already mentioned, our deficit is actually still quite a bit lower than theirs. But that borrowing of $500 billion, that is a rollover of the existing debt that's outstanding, right? So some of it's new debt, but a lot of it's just old debt being rolled over. I used to be more concerned about this than I am. I've learned after writing 2 books about it that the big scary monster that nobody ever talks about is the private sector debt. And in Canada, 227% of GDP is household debt plus corporate debt, non-financial sector debt. And that's basically right in the top levels in the world of private sector debt. And several people have done studies that show that in the 1920s, a rise in the level of private sector debt is what caused the downturn in the U.S., not the public sector debt, but the private sector debt. The government can usually, and in the case of Canada, this is probably likely to be okay, can usually issue their own currency to roll over their debts. They never pay them back, they just roll them over. But a private sector household cannot roll over their own debt. They can't issue their own currency. They can't go to the bank and say, "Hey, I got this new Goddard coin that I want to give you to pay off my debt." It's not going to work. So you gotta convince somebody that can actually issue currency, like a chartered bank or the government, to give you the money. And that's where the problem in the private. So you get these defaults in the private sector, and those defaults have been creeping up higher and higher. So everybody gets excited about public sector debt, and it is a problem, but it's not the problem that's going to do us in. The more likely that we're going to, if there's something coming that's going to push us under, it's going to be the private sector debt, and caused by a decline in real estate prices, which is by far the most common collateral for all of this private sector debt that's sitting out. Even in the corporate sector, a lot of the debt is backed by real estate. They build a factory. The bank loves it when they build a factory. You get some land, you get a building. Because they're not, they've been burned many times by businesses that, can't make a profit. But at least they can seize the land and the building. So they're much more excited about giving a company a loan if they've got some collateral like that to offer. So a lot of this debt is backed by real estate, which is scary if you think about the possibility that real estate could go down. Now, most people weren't thinking about the possibility real estate prices could go down. So it would only be a problem if it turned out that real estate prices can actually go down.
Canada mortgage bonds increasing annual issuing limit to $80 billion, with actual land ownership up in the air in BC and Quebec, likely to spread across the country. Who would invest in these bonds?
I think people, because they're guaranteed by the government of Canada, I think people are pretty okay with investing in those bonds. The interest rates on mortgages, we haven't talked about that. They peaked at 6% roughly, and they've come down to about 4% now. The Bank Canada rates come down more than that. It's come down from 5% down to almost 2%. So Bank Canada rates come down almost 3%. The mortgage rates come down. It peaked just under 6%. Now it's about 4%, so about 2%. And so that people don't want to park some money into. The government of Canada bond is almost the same yield, so not quite sure why people would buy one versus the other, but these things are considered pretty safe. Although there was a time in 2009, people don't know about this, but there was a time in 2009 when all those mortgages, the subprime mortgages in the U.S. were going under. Nobody would buy a Canadian mortgage, even though they were backed mostly or entirely by the government of Canada. The world bond traders would not touch Canadian mortgages. So the government of Canada brought in this program called the Insured Mortgage Purchase Program to buy up to $120 billion worth of mortgages from the banks. And they bought a lot of them. I think they bought a total of 60 or 70 or 80 billion in mortgages from the banks at a very nice price for the banks. And that helps bail the mortgage market out. So they might need to do something like that again, but I'm sure they would if it ever got into any kind of trouble.
Are critical minerals exploration tax credits a good idea?
So we've had those mining tax credits for at least 40 years. And the way they work is these junior companies can't really use the tax. There's a credit for exploring, a tax credit for exploring, but you need profits to make it work, right? So a lot of these junior companies, they don't have profits. They're spending money on exploration. They're losing money. They keep raising more money on the stock market, and they spend it all on exploration, and they don't have any profits. So these tax credits lie unused. So what happens is you get doctors and dentists coming along, and they'll buy these shares that have these tax credits from these junior mining companies attached to them. And they get two things. They get ownership in the junior mining company through the shares, and they get the tax write-off from having invested in those shares. The problem I've noticed over the years is the good junior mining companies generally don't tend to issue them because they might need the tax credit themselves. And the ones that do issue them, they always seem to jack up the price on them. So you're better off just to buy the regular shares without the tax credit. Well, yeah, of course, I'm very conservative, but it always seemed like a bit of a gimmick to me. I don't think it's going to make that much difference. I mean, the reason for investing in these things has to be there's a huge expansion in the market for these minerals coming in, and the tax credit isn't going to make that much difference to that equation.
More mass immigration for Canada planned for 2026, 765,000 migrants, 385,000 international students and temporary foreign workers, and 380,000 permanent residents. Where are we going to put all those people?
You know, I've seen numbers that don't agree with that. I like there have been in the past, as I mentioned in 2023, or I think it was 2023, that the numbers got up to a very high number. The growth in population was up above 3%. But the forecasts for next year are down for it to come down below 1%. So I'm not sure where those numbers come from. I think that whole immigration thing is going to come to a really hard stop. Politically, it's just no longer a positive thing. And it's going to have a lot of impact on a lot of businesses because they rely on those people for employees. And a lot of the biggest impact is probably going to be educational institutions where people would sign up for an easy way to get a 2-year permit was to get enrolled in in some kind of a college program, as I understand it. And then you could be good for 2 years. But those people were running those programs pretty aggressively, and making good money, providing good employment for a lot of professors and things like that. And that seems to be slowing right down. So no, I think it's those numbers are not going to turn out to be correct. I think the numbers are going to be much smaller than that.
Artificial intelligence has to be programmed. Could it be programmed well and not so well? Are you bullish on AI stocks that are in a bubble?
I think they are in a bubble, AI stocks. I'm not sure about the programming part. I did notice that the NVIDIA. So NVIDIA now is worth the most valuable company in the world is NVIDIA. It's $5 trillion US dollars, I think. And what they do is they make this chip, and they keep improving it. They keep coming out with a new chip every year or 18 months, and everybody's buying them and trying to buy them, and they're making 80% profit margins on them. But in a speech I listened to, I think it was probably about 6 months ago, he mentioned, he said, our chips are good, but our software is even better. He says, our software is even better. So he's already recognizing that the software that controls these chips is going to be more important in the long run than the chips themselves. So for sure. And it's in a bubble. There's a huge competition going on right now between who could spend the most money to set up these data centers, to get these chips, to put them to work, get the electricity for them to work. But also, Meta, formerly Facebook, has paid some ridiculous amounts of money, like over $100 million to signing bonus to bring some smart young people over to work on AI. So, but I always remember, like about 3 years ago, I was talking to a fellow in the IT business. He was actually originally from India, as a lot of people are in that sector. And he said all the Chinese people that he knew that were the really good ones were all moving back to China. And this was 3 or 4 years ago. And so China is working just as hard or harder than we are. The difference in China is they're not talking about building these huge data centers. They're working on on figuring out how to program these things and how to make it work. So it's hard to visualize how it's all going to settle out, but for sure it's a bubble. All bubbles burst eventually, and there's going to be a lot of very big losses in the stock market based on who the winners and losers are. It's really hard to tell at this point, which ones are going to survive and which ones don't. The two companies out of the 2000 bubble that burst were Microsoft and Cisco. And Cisco made the routers, and Microsoft is Microsoft. Everybody knows what they do. And the one company now that's in the Mag 7, Magnificent 7, almost said Mega 7, Magnificent 7, that survived from 2000 is Microsoft. It's the only one that survives. So, and everything that people were saying in 1999, 2000 about the internet has turned out to be true, and way beyond what anybody anticipated, right? But that doesn't mean the companies survive, right? So it's going to be, there'll be lots of entertainment, and for investors, going to be a lot of big wins and big losses.
The U.S. stock markets continue to be overvalued and keep moving higher with bank rates dropping. Could stock markets continue to move even higher?
Well, they can always go higher, but eventually they come back down to earth. And the size of the bubble today versus 2000. So 15 years ago, we had the bubble in 1999, 2000. Now we got this one. In those Magnificent 7 stocks, the size of the bubble today is actually a lot bigger than it was back then. There's different arguments about that, but you look on the charts and that, it looks definitely much, much bigger. So for sure, those bubbles always burst. And the problem is timing. So how do you figure out what the timing is? Well, a couple of things happened this week. The market's actually down today as we talk on Thursday. It's down a couple of percent, but still within less than 10% drop from a peak. But Warren Buffett retired on last weekend. It was his last letter at the age of 95 or 96. And Michael Burry, who's the guy in the Big Short that shorted those subprime mortgages, he figured out a way to do it, and is now shorting Palantir and NVIDIA. Those are the two leading companies in this bubble this time around. And then he's just today he sent out a letter saying he's closing up his investment shop. So he actually bought puts, which is similar to selling short on these two companies, and then he just stopped running his investment company. So I don't know if those are signs, but it's interesting they would happen within 10 days of each other. And then the other thing to remember is Berkshire Hathaway, Warren Buffett's company, has got almost $400 billion in cash, the most they've ever had, way beyond whatever they've had. In a $1 trillion company, 40% of it in cash, which is earning very little. So he obviously, now maybe he did it because he knew he was retiring and wanted to leave a clean slate for the next group. But I'm sure it's also because he thinks that valuations are much too high in this bubble. He's going to wait for better pricing.
Is consumer debt concerning?
Well, consumer debt is small in relation to mortgage debt. So mortgage debt is the big thing. Consumer debt, in BC, consumer insolvencies just hit a record high. So now there's two types of insolvencies for the consumer. There's the one where you go in and do a proposal, which is credit cards, car loans, anything, but not mortgages. It doesn't touch your house. And then the other one is the actual bankruptcy. So these bankruptcy trustee people, they try to talk you into doing the consumer insolvency, because then you get to keep your house and, it doesn't get all involved in that. And they try and talk the lenders into taking like 20 cents on a dollar, 30 cents on it. So you say, you owe us money, I can't possibly pay it back. I owe you $100,000, I'll give you $30,000. I'll give you, $1,500 a month over however many months, 20 months to pay off $30,000. They agree, everybody agrees, and the trustee supervises that, and it's all taken care of. And but the problem with that is that the reason those things are rising is because in the past, people that were homeowners were able to, it's not that they didn't have consumer debt. It was a problem. It's always been a problem. But they could refinance their mortgages because the house price went up, right? So they always had a bailout with the rising house price. And now they don't have that anymore. And now we're starting to see a big uptick in consumer insolvency. It is a big problem. But car loans, I'm sure, are going to be a story, amazing story. In the U.S., student loans are a big deal, not so much in Canada. But in the end, the mortgages are the big thing, because that's mostly what people, people they generally don't owe hundreds of thousands of dollars in just consumer debt. It's usually mortgages that are the big number.
What's the latest in the world of electric vehicles?
So the big thing is happening, well, a couple of big things happening. One is that Tesla is not doing very well. So the numbers came out, and Tesla, I don't know if it's because of his flirtation with Donald Trump. Well, more than a flirtation, they had an affair, I guess, if you like. And the people in Europe are not very happy with that, so they're not buying the Teslas. So their quarterly numbers for the period ending September 30th were quite bad. And the new Model Y is still very popular. The Model 3 is somewhat popular. Cybertruck's not selling very well at all. But the big story, so that's on the negative side. On the positive side, the big story is BYD. So this is the Chinese company that we've talked about in the past. It's second or third biggest in China, but it's by far the biggest worldwide outside of China. So it's surpassed Volkswagen, Toyota, all those companies in electric vehicle sales anyway. And they're on track to produce something like 5 or 6 million cars next year, and most of them will be exported. So that's still not in the Toyota and Volkswagen peaked at around 10 million. They're still not quite to that level yet, but in the electric side, they're ahead of everybody. And the thing about BYD is they make their own batteries. So they've got that advantage. Like Tesla makes some of their own batteries, but most of their batteries are made by Panasonic or LG Chem, which is a Korean company, or CATL, which is the biggest, it's a Chinese company, the biggest battery maker in the world. So, but BYD makes their own battery, because the battery is the only complicated part of the electric car, and the battery is really important. So the new thing now is BYD's got batteries where you can charge your car in 6 to 10 minutes, take out a couple of 100 kilometers or more of charge in a very short period of time. And that gets rid of a lot of the range anxiety problems. It's also going to put out there's a company called NIO that was offering battery swaps, because the idea was, okay, you go 300-400 kilometers and then you just swap your battery for a new battery, and that way you don't have to stop. But now that they've got the recharging down to less than 10 minutes, it just takes about that long to swap a battery anyway, so you're better off to not have all that hassle with swapping the battery. So it's going to have a big impact on the electric cars. So in China, it's like 50% of all sales are EVs. And in the world, outside of North America, it's up over 20%. So it's moving very rapidly. Now, in North America, Canada and the U.S., it's still under 10%. So North America is the last place that is really keen on electric vehicles. But there's a rumor that Canada might drop the 100% tariff on electric cars. So that would become a huge in for BYD if they want to sell their cars to China. And their cars are much cheaper than what we're being offered to buy from Tesla or GM or other offerings.
Hilliard, where can people follow you and where can they buy your book?
So they can buy my book anywhere in the top bookstores or online with Amazon and Kindle and that sort of thing, Kobo. And they can follow me. I am on Blue Sky, but most of the people seem to still be on X, HMACBE, and I post stuff there occasionally, and they can contact me through there. My direct messages are open, so hope to hear from them. Thank you.
Hilliard, thank you so much for being on This Week in Money.
Thank you, Jim.
My guest has been Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He was speaking to us from Edmonton. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Eric Hadik, and Hilliard MacBeth. And thank you for listening. If you have any questions for the show or for any of our guests, you can send them to info@HowStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.